Gold just surged, and that's usually when people start thinking about selling, but this time selling is the wrong move because a signal just flashed green, and historically, it only appears before the biggest moves, not after them. Here is the contradiction that should stop you. Gold climbed through one of the largest physical demand events on the planet, and price didn't flinch. No correction, no sell-off, no volatility spike. That shouldn't be possible. In every normal market cycle, peak demand creates peak vulnerability. When the most buyers are active, smart money sells into the strength. That is the oldest trade in commodities. This year, that trade failed quietly, and almost nobody noticed. This is where things change. The event in question is Lunar New Year. Not as a cultural celebration, but as the single largest annual stress test of the global physical gold market. Every year, Asian demand surges. Every year, supply chains stretch. And every year, that surge eventually fades, and price corrects. Except this year, the fade didn't come. Demand absorbed, price held. Accumulation continued after the event passed. Seasonal demand is supposed to fade. This year, it didn't. And that asymmetry, that absence of the expected correction, is the signal, not the price, not the rally, the absence of what should have happened. That is what makes this moment structurally different from every lunar cycle before it. Now here is the mechanism most people don't understand. The global gold market operates on two parallel tracks. The first is paper gold, futures contracts, ETFs, derivatives, leveraged positions. The second is physical gold, refined bars, allocated vaults, settled delivery. These two tracks are supposed to move together. They rarely do for long. Paper gold can be created in unlimited quantities. A futures contract requires no metal to exist, only a promise. Physical gold requires mining, refining, transport, and settlement. When the two tracks diverge, one of them is wrong. And here's the part nobody is talking about. During lunar demand season, physical gold flows from west to east at accelerated rates. London vaults, Swiss refineries, COMEX registered stocks. All of them supply the Asian physical market when demand peaks. This year, those flows happened, and Western paper pricing barely registered the drain. That disconnect is not sustainable. At some point, paper pricing must acknowledge physical reality. It always does. The only question is when, and from what level. Now watch what happens next. Central banks have been accumulating gold at a pace not seen since the 1960s. Poland, China, India, Turkey, Singapore. Not as a hedge, as a reallocation. The distinction matters. Hedges get unwound. Reallocations don't. In 2023, central banks purchased over 1,000 tons of gold for the second consecutive year. That number has no modern precedent outside of post-war reconstruction periods. These are not momentum buyers. These are entities that measure time in decades. And this is the part that escalates everything. When central banks buy at this scale, they are not predicting a price target. They are pricing in a structural shift in the monetary system. Gold doesn't move to $5,000 because analysts forecast it. Gold moves to $5,000 because the system reprices it. Let's be precise about what $5,000 means and what it doesn't. It is not a prediction. It is not a hype target. It is the mathematical consequence of current reallocation trajectories meeting constrained supply. Gold doesn't explode upward. It gets reassigned. Here's the supply constraint that makes this inevitable rather than speculative. Global gold mine supply has been essentially flat since 2016. Discovery rates are declining, grade quality is falling, development timelines are extending, new mines take 10 to 15 years from discovery to production. Supply cannot respond to demand in this cycle, not materially. At the same time, demand is not just growing, it is changing in character. Investment demand, central bank demand, physical retail demand from emerging markets, three separate demand pools, all drawing from the same constrained supply. That is not a rally, that is a repricing event. But here's where it gets strange. Despite all of this, the central bank accumulation, the lunar signal, the supply constraint, gold volatility has been falling, not rising. When a commodity with tightening supply and accelerating demand becomes less volatile, something structural has changed. Volatility collapse in gold historically precedes the largest single-directional moves, not the most turbulent moves, the most sustained ones. Because volatility dies when one side of the market stops participating, and right now sellers are withdrawing. This is where the historical parallel becomes impossible to ignore. In 2005, gold traded between $300 and $400 for nearly 2 years. Volatility collapsed, volume thinned, analysts called it a consolidation. Then, between 2005 and 2011, gold moved from $400 to $1,900. The consolidation wasn't weakness, it was loading. In 2018, gold consolidated again, same pattern. Volatility compression, sideways price, analyst fatigue. Then 2019 through 2020, gold moved from 1,200 to over 2,000. The pattern is not coincidence, it is mechanism. And this is the part nobody is talking about. The lunar signal isn't just about China's appetite for gold, it's about what happens when the world's most price-sensitive physical buyers absorb supply without creating downward pressure on price. That means the market has already cleared. The metal available for sale at current prices is already owned by someone who won't sell it. When available supply disappears without a price spike, it means accumulation happened quietly, below the radar, before the breakout. That is the definition of smart positioning. Now let's look at what is happening across multiple markets simultaneously. The LBMA, London's wholesale gold market, has seen lease rates spike. That means gold available for lending is becoming scarce. When gold can't be borrowed easily, synthetic short positions become expensive to maintain. Expensive shorts close. And when shorts close, price rises. Simultaneously, gold ETF holdings in the West, which declined steadily through 2022 and 2023, have stabilized. The liquidation phase has ended. Western institutional sellers have left the market. What remains is structurally long. And COMEX open interest, the number of outstanding gold futures contracts, is rising again after a prolonged period of contraction. New money is entering, not short-term, not speculative, directional positioning for a sustained move. 3 groups of people are watching gold right now. The first group is selling. They see a rally and they take profits. They are applying the logic of the last cycle to the conditions of this one. That is the most expensive mistake in markets. The second group is waiting. They want confirmation. They want a pullback. They want a cleaner entry. By the time that entry arrives, the structural move will already be priced in. Waiting for confirmation in a repricing event is the same as missing it. The third group understands the signal. They recognize that the lunar confirmation, the central bank accumulation, the volatility compression, and the supply constraint are not separate stories. They are one story told across different markets in different languages at different speeds, and the story ends at a different price than where we are now. So what does this mean? Structurally, not emotionally, it means gold is transitioning from a trading asset to an ownership asset. Trading assets get bought and sold around price levels. Ownership assets get held through price levels because the holders understand that the price level is not the point. The reallocation is the point. It means the $5,000 figure, however it arrives, is not the end of the story. It is a waypoint in a structural repricing of what gold represents in the global monetary system. When reserve currencies are debased at scale, the asset that cannot be printed gets repriced at scale. That is arithmetic, not speculation. It means the institutions that moved first, the central banks, the sovereign wealth funds, the allocated account holders, will not sell into this move. They built their positions for a reason that has not yet fully expressed itself in price. When they sell, we will know because they will tell us through policy, not through markets. Here's where we land. The lunar signal wasn't the catalyst. It was the confirmation. Catalysts create moves. Confirmations validate them, and validation at this scale across physical markets, central bank behavior, supply dynamics, and volatility structure does not happen in ordinary cycles. The next phase of this move will not announce itself. It will not come with a headline or a press conference. It will come through price, quietly, then quickly, then obviously. And obviously is always the most expensive time to understand it. When the strongest gold demand event in the world passes, and price doesn't flinch, you are no longer early, you are positioned. The question is not whether this moves, the question is whether you understood it before the price confirmed it for you. If this gave you a framework the financial media hasn't, subscribe. We don't cover what's already priced in, we track what's moving before price catches up. Leave a comment. Do you think gold is in a structural repricing, or is this still a trading rally? That distinction is everything right now.